Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
One of the stocks in the news is Delta Airlines. Stock's up 13.8% here today. Delta Airlines reinstated profit outlook for the year. And they say that the travel in the U.S. is climbing back. Corporate travel is strengthening, so looks pretty good. And consumers have become a little numb to the ongoing trade disputes. That's according to the CEO.
Is being numb good, though?
Not exactly. Maybe relative to
you're flying.
Exactly.
Maybe.
George Ferguson, he does this stuff for a living. He follows all the airlines and all the aerospace companies for Bloomberg Intelligence, joins us now. George, what did you take away from kind of Delta? What's changed since they pulled guidance and now they're reinstating their guidance?
Well, I think what's changed since they pulled guidance is that guidance got lower, but they didn't mention that, right? So they reinstated guidance, but at a lower EPS than they had initiated at the beginning of the year. I think the market still looks a little bit soft to us. For sure, fuel prices are giving airlines a bit of a bolster on the bottom line. But I think, what we heard today was on the demand side was more of the continuing story, and that is that premium is holding up really well, and Delta's going to do very well there because of their loyalty programs and such. Basic economy isn't. And if you look at Delta's, price paid per mile flown for customer, it was down in every single market that they served, or maybe flattish in Latin America, but all the rest of the markets down during the quarter. So to us, it looks like a market that still needs to have capacity come out. And some of it will in the second half. So.
The CEO pointed to progress in trade talks between the U.S. and other countries and the potential for some geopolitical conflicts to abate. I mean, the flying public really, I don't know, are they really thinking about this when they book a flight on Delta or any other airline?
Yeah, I mean, so when I think of that, I think that's going to largely benefit his international business. I don't know. Paul likes to pick on me because I get to Paris for Paris Air Show, every other summer. And when I was in Paris, it was teeming with Americans. So it didn't seem like, even with protests going on around, it didn't seem like demand was off for international travel, at least, anecdotally in some of the places I've been to. So I don't know. I mean, I think it takes a little bit of demand off, maybe a very little bit. But right now, I think the international traveler seems to be rolling right over top of that and going anyways.
George, how does an airline take capacity out of the system? Is that just going from like 10 flights between Newark and Miami a day to, 7 or 8?
I mean, I think ultimately you got to park airplanes. It's a capital-intensive business. You don't want to buy those airplanes and not utilize them. You take your old stuff, you park it, you maybe retire it, sell it off. But what we're seeing as 3Q develops, and so we'll watch this closely to see what it does to demand, is we're seeing that the low-cost carriers, Spirit, Frontier, look like they're taking large portions out of their plan for 3Q. Now it may not hold. They may add some of those routes back, some of those seats back, but we're seeing numbers down 20% in some of their capacity. On the full service side, United and Delta is still adding. United adding the most, I think, I want to say 5-ish, 6-ish% when I looked earlier today. Delta adding 2-3-ish%, an economy that's not growing that fast. American looked kind of flat, meaning the economy's growing at rates, sub 2%. So it feels like the big full service are going to push through here and try to push through and continue to subsidize the front of the cabin, subsidize the back of the cabin, that basic economy with the front of the cabin strength. I feel like at some point they'll break that front of the cabin. I think that's sort of how the industry always works, but we'll see.
In none of these reports do I see anything mentioned about jet fuel prices. Should we be concerned about that?
Well, I mean, right now it's a tailwind, and if that reverses, could be a problem, right? But I mean, jet fuel prices are down because of slower global growth, right? I mean, I think the geopolitical backdrop doesn't help it, but it doesn't seem to have push prices up firmer. I think I saw today Saudis are talking potentially about reducing some of the capacity adds that are coming on. I don't know if that sounds strong enough yet, but if jet fuel turns, that would work against them. Because again, we've got an airline business. If you look at Delta, they added 3-ish% capacity or around there for this quarter, and revenues were flat, right? So they're adding capacity and revenues are flat. I generally don't like that kind of backdrop.
Business travel, Delta actually kind of called that out as perhaps corporate travel is quote unquote strengthening. Are you seeing that across the industry? And where's corporate travel versus pre-pandemic?
Yeah, so they're not telling us anymore, right? And usually you tell us when you're really excited about where it is. Look, I think the summer flying seasons are all about leisure. What I heard was that they were having weaker pricing power in sort of the off-peak demand times. And my read-through on that is that summer leisure traveler, where they know they got you, right? All my friends call me, they go, hey, George, I hear airfares are down, but I'm trying to travel over July 4th week on vacation with the family, and I'm paying a crazy price. And I'm like, yeah, because you're going when everyone else in the world wants to go somewhere, right? So when I read off-peak, I also think that's probably a little bit of business travel. And so I don't know that it's going swimmingly, and they're not giving us numbers. What I heard was kind of stabilized, but I didn't hear something that sounded like it was getting much better. And again, summer's about leisure.
I live in the flight path of, I guess it's Kennedy.
Everything. Yeah, Kennedy.
Well, everything, yeah. Sometimes I look up and I'm like, oh, wow, a jet. It's amazing to me, George, that I guess the engine technology has advanced so much that I barely hear them. Should I get excited about the advancements in jet engine technology? 30 seconds.
Yeah. Look, first, I'm jealous because you're in the flight path of everything. And yeah,
you come over anytime.
I'll sit there with a lawn chair and we'll watch them. Jet engine technology is outstanding. It's probably even getting quieter and more fuel efficient. It'll cost more to maintain over the long run, but going the right direction.
Years ago, George turned me on to this app, Flight Radar 24.
Oh, it's great.
So you can track every plane, and now...
And you there's also a button where you can push where you can get the cockpit view.
Yes.
Like, pretend you're flying.
It's great. So now I'm completely addicted to that. George Ferguson, Senior Aerospace, Defense, and Airlines Analyst, Bloomberg Intelligence, giving us the latest here on Delta. And again, Delta stock up about 13% here today on news that they are putting out guidance, which they had pulled their guidance. So Street taking that as a positive sign that the company has some confidence in their business outlook.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Speaking of technology, we like talking to Mandeep Singh. He's a senior tech analyst at Bloomberg Intelligence. All right. You've schooled us on AI over the last several years. I think I now understand what it is. I understand that it's big. It's a big business, but $4 trillion market cap for Nvidia. Are you kidding me? What's going on? I mean, tell me that's overvalued.
Well, when you see a company that's growing 50% and is able to generate almost $100 billion in free cash flow, then it's not. Wow. And that's where, you have to look at it from the lens of what is sustainable versus what is happening right now. Now, typically, chip companies, we know they have that cyclical element where, after a period of rapid growth, there is a digestion period. I don't think this time is any different, but what we are witnessing now is a super cycle in terms of the build out of AI infrastructure. So you are not going to see a very quick slowdown simply because right now we are in AI land grab mode. Everyone is, we talked about picks and shovels for the longest time, in the past 12 months. That trade is still ongoing simply because the demand for GPU compute really continues to rise because you have this explosion in coding agents now. Think of what has coding agents done in the past 6 months. That is the use case that every hyperscaler is using now. Every enterprise is looking to deploy. In fact, Microsoft said 35% of their new code is written by a coding agent. That's all
Wow.
AI GPU based. And that's why there is so much excitement.
And if I'm in a company with earnings coming up, I don't have to wait very long to show the results of my big investments in AI, do I? It's already there, right?
Well, I think for hyperscalers, especially a Microsoft.
Well, the end users, I mean the regular Joes out there.
Yeah, I think, again, depends on which sector you are in and how far along you are in terms of deploying those. I mean, what these companies have shown is not only are they investing in AI data center build out, they're actually deploying it in-house. And Microsoft is the prime example of that, where they've done a couple of restructurings. They've said 35% of their code is written by AI. So it's hard to argue against the proof points that they're giving us. And look at OpenAI's growth. They've almost doubled their revenue in the first 6 months of the year. Anthropic has 4x'd its revenue from 1 to 4 billion in the first 6 months of the year. That kind of growth, it's hard to argue against. And you're right. I mean, some of it will be visible in, the companies that are using it as end customers. But really, there is so much runway because these use cases are all new. And everyone is looking at the productivity aspect, and that's what everyone is excited about.
All right, let's switch gears to something near and dear to my heart, which is paying huge compensation packages for people. It used to be like in my Wall Street.
This is like sports teams.
You did it for bankers and traders.
Yeah.
Now, in your world, the geek engineers are getting pay packages of $200 million. I'm seeing Meta Platforms has made high compensation offers to new members of its superintelligence team, including more than a $200 million package for a former Apple executive. What's going on here?
Well, I mean, with this AI wave specifically, when you think about the transformer model and the subsequent development, a lot of it has been pioneered by, I would say, 100 to 200 AI researchers that were at the forefront.
Wow.
So if you are one of those, and you, everyone knows you are either working at OpenAI or Anthropic or Google, DeepMind, that's where, Meta was like, we are lacking behind in our large language model efforts. We have really got all the compute and the data. What is it that we can do to fill up that gap in terms of why our model is not being as heavily used as an OpenAI model? So they have brought in all the researchers. I doubt they will be able to fix all the problems with their model by bringing in all the researchers over the next 6 months. But what it could do is slow down OpenAI, because OpenAI was shipping product, pretty much every month. Now, suddenly, if you lose 2 or 3 of your key people, then maybe GPT-5 doesn't get shipped in the second half. So I think what Meta has done is really made every attempt to slow others down. And then in the process, they'll have more time to catch up. And I think that's seems to be the strategy.
These are Shohei Ohtani type contracts out there. Mandeep Singh, thank you so much. Because these guys can't.
I hope Mandeep doesn't leave.
Yeah, exactly. We're going to see him leave.
Don't go.
Exactly.
200 million. That's a nice
you wave it on the way out the door. Mandeep Singh, Senior Tech Analyst for the moment at Bloomberg Intelligence here in our Bloomberg Interactive Brokers studio.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, John Tucker, Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well, so check us out there. Amazon Prime Day, which I know you're all over, John, is actually Prime Days plural. I think there's 4 of them.
So you spread it out and things are...
I don't know, but it just gets you to just buy stuff in July. I guess you wouldn't ordinarily be thinking about buying stuff. But let's see how it's going out there in the world of retail and e-tail. Punam Goyal, Senior U.S. E-commerce and Retail Analyst, joins us here. She's at Bloomberg Intelligence. She's down there in Princeton. Punam, what are we learning about Amazon and Amazon Prime Days and maybe how the consumer's doing these days?
Sure. So, the days, it's 4 days this year versus 2 days last year, so longer, which means that people have more time to shop. So early reads from different third-party vendors suggest that sales were down in its first day. And I'm not surprised by that because there's no urgency, right? You have till Friday, midnight to shop. So I think people are taking their time. Overall, we do expect Prime Day versus last year will be up by the end of it. Consumers are looking for deals. prices are going to go up with the tariff situation, and the best time until Black Friday to get deals is this week.
Okay. You always leave it to me to ask the stupid questions. Well, what are the big sellers on Amazon?
So what they're pushing is exactly what they've pushed before. You have electronics, you have home products, you have the vacuum cleaners, you have the devices that they have, whether it's the Alexa. It's really a little bit of everything is on sale. The average discount that I've seen, there are clearly some things that are 50, 60% off, but I'd say the average discount is probably in the 20 to 35% range from just the products that I've seen as I've been tracking it.
But that's the stuff they're pushing. What is the stuff people are actually buying?
I think they're buying what they're pushing because people want to buy what's on sale, right? So if it's not on sale, why do I need to buy it today? I can wait till I need it.
All right. So next Wednesday, we are picking up our new puppy. And so we've spent the last couple days taking advantage of Amazon Prime, buying a lot of dog stuff.
Is the dog stuff manufactured overseas where you're now paying
I don't know.
Tariffs
I don't
or
know. I'm just
anticipated
assuming
tariffs?
yes. And that's kind of where I wanted to go, Poonam. If we haven't seen the tariff impact yet, or maybe we have, I don't know. When do you and the retail companies you talk to, when do you think the tariff price increases, if any, come through to the consumer? They may not. When do your companies think we'll see it?
So I can tell you that I think they're there, but they're selectively there. Companies have already started to raise prices. Nike, for example, has raised the price of its sneakers that are over $140 by $5. And that's at the 10% pause tariff rate. What I'd say, it depends where these rates settle. Right now we're hearing Vietnam 20%, and that's 10% versus 20%. So now Nike, will it have to increase its rates further? I think so. They will absolutely have to do that. They said the 10% is costing them an additional $1 billion in costs this year in their fiscal 2026. If it goes to 20%, Vietnam is a big sourcing country for footwear especially. They're definitely going to have to take prices up unless they're going to let the margin take a hit.
Do these companies like Puma, do they have to reinvent themselves in light of all this?
So to a certain extent, they have to think about their cost structure a little more. But what I would say is Puma is a little more diversified, right? It's a European name. So the exposure to the US is less than what it is for a Nike. So they do benefit from that. Even Adidas, for example, their exposure to the US is less than Nike. So they can take what they make in the higher tariffed countries and use that for everywhere else but the US. So they do have some strategies that they can deploy and are already deploying. But strategies will have to change, right? Will materials get compromised if the consumer is not willing to pay for the added costs? These retailers cannot absorb a 20% tariff. They just cannot. Their margins are in the single digits. So it's just not something they can afford.
So that's interesting. So Bloomberg News is out with a story saying that, talking about the running category, and that's critical for a lot of these sneaker makers and how competitive it is. How do you think about that part of the retail space?
So running is a very important category for all the athleisure brands. I would say probably since the pandemic, it's grown in importance as there have been more people that choose to run. Now, is it going to be easy for any of them to win the running race? No, because really the clear standouts in running today are the Ons, the Asics, the Brooks, and the Nikes. Those are the names that you kind of think of when you think about running. And while Puma has its own shoe and so does Adidas, it's going to be hard to penetrate in that market because the others aren't slowing down. Everyone is laser focused on this category. And we'll just have to see who bites at what because it is a very, very competitive category in the athleisure space.
And I'll quote Calvin Coolidge here. I choose not to run.
That's exactly right. I don't know.
I can use it, though.
I'll walk on the boardwalk today.
There we go. All right. I'll stick with that.
All right. Poonam Goyal, thank you so much. We appreciate that. Poonam Goyal, she covers all the retail stuff for Bloomberg Intelligence.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. Well, a lot of investors trying to get a sense of how the consumer is faring during this time of uncertainty brought about in part by all this discussion of tariffs and what it might mean for the economy. One of the areas they look at is the retailers. What are the retailers seeing? Well, today on Bloomberg Television, Ralph Lauren CEO Patrice Louvet said that demand for its signature clothing, such as cable knit sweaters, remains strong, even as the fashion industry is buffeted by tariffs and an economic slowdown. Let's break that down a little bit. Mary Ross Gilbert joins us. She's a senior equity analyst covering the retail space for Bloomberg Intelligence. She joins us from LA via Zoom. So, Mary, we heard from the Ralph Lauren CEO says he still sees demand kind of pretty solid. What do you make of his comments, and what are you seeing across your retail coverage?
Yeah, so Paul, we're seeing strength clearly with Ralph Lauren. When we look at the data for the June quarter, which they're going to report in early August, their sales are trending up about 20%.
What?
And that's just for the U.S. market. And the U.S. is about 42 to 43% of their sales. And when you look at the consensus, they're at 6%. So they're really hitting it out of the ballpark. And it's not just in the U.S., it's actually around the globe. So when you think about China, China is supposed to be having a slowdown, but not for Ralph Lauren. Their sales in the last quarter, which was the March quarter, it was up 20%. So they're really seeing some strength. And when you look at some of the other brands out there, I think you'll see some variability. You'll see some retailers kind of struggling. So on the value side, we saw American Eagle show some struggles there, but part of it had to do with some fashion misses. So it was really associated with execution. And then the other companies that are executing, we're seeing good sales trends. And so we're seeing off-price is still showing resilience. So we think the consumer really is showing resilience.
Where does Ralph Lauren make its stuff?
That is a good question, John. So about 20% comes from Vietnam. China is probably around 7 or 8% is what we estimate. So they've been diversifying. And of course, we just got the news about a week or so ago that Vietnam tariffs are going up to 20%, possibly by August 1st. They haven't set an exact date yet, and that's up from 10%. So when you think about non-China tariffs for apparel retailers, that's about 10%. And so then does this mean Vietnam at 20% is sort of the new, we're going up to 20% for non-China? Yep. And China right now is at 30%. So we estimate that would be an incremental 26 basis points impact. But if anything, Ralph Lauren has the ability to pass on price increases and to be less impacted. They have pricing power with their consumers. Their average price point has been marching up, and consumers are willing to pay full price. If you look at their Wimbledon collection, good luck trying to find something because a lot of it has been sold out.
So is that how you're approaching tariffs here, Mary, as you look across your research coverage of retail companies? Is the higher end will have a better chance of passing along price increases versus maybe something towards the mid or lower end?
Yeah, it's going to be a combination of how these companies are able to mitigate the impact. I mean, we certainly saw in 2019, remember 2018, 2019, Trump 1.0. Most of these companies were able to sort of cycle past it. So even companies on the value side will look for strategic price increases. So they'll be very pointed in that. But they're also sharing the costs with their suppliers. So the suppliers are absorbing some of it. In that Trump 1.0 scenario, they actually absorbed half the cost. So there are ways to mitigate it. Obviously, focusing on your costs, continuing to reduce your costs. So all of those things. So there will be an impact this year, mainly in the second half. But then as we get, into 2026, most of these companies will be able to cycle past that and hopefully see some margin improvement, depending on how final negotiations come out on tariffs.
In the meantime, does resilient demand more than make up for any hit to margins? And by the way, parenthetically, I have to tell everybody, I think that's Ralph Lauren she's wearing.
I'm wearing Ralph Lauren.
Oh.
And that was coincidental.
I'm not going to say it's a conflict of interest.
I had no idea. I came in, but I guess I'm an example, but it's not me. When you look at the fact that they added 5.9 million customers,
I didn't mean to put you on the defensive.
It's mainly younger consumers. So millennials and Gen Z love the brand.
Wow.
So you will be seeing it more and more on them.
All right, good stuff. And we're going to be talking to you more and more because as the retailers report, it's going to be really a good view as to how much they're taking in their margin versus how much you and I are going to be taking.
The CEO also cited for Ralph Lauren increased demand, not just like from the tennis set, but from what's that other sport that's kind of like
polo?
No, the
Cricket.
one that's kind of like baseball.
Oh,
Cricket.
Yes.
The cricket set.
Like, huh?
Yeah, exactly. All right,
My
Mary
cricket
Ross Gilbert.
wear.
Absolutely.
Thank you so much. Mary Ross Gilbert, she's a senior equity analyst covering retail for Bloomberg Intelligence.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.